recording and running things, getting people in and out of the rooms. And then we would like to introduce our speakers today, Patty Peterson from Kutak Rock and Judith Crosby from Kutak as well.
Yes.
So they are going to, and it might be, I don't know how you guys are going to divide this out today, if it's all going to be on Judy. Um, but uh, we they will give us an update on the changes to the state housing tax credit, and then talk a little bit about how the structure can really work with nonprofit and how that will work. So we will go ahead and turn it over to Patty and Judy. And Judy, you are on mute when you're ready.
Well, I will say, and you're correct, Sarah, that Judy's running this show, but I'd like to introduce to the group that's in attendance Judy Crosby, who is one of our tax partners here at Kutak Rock, and Judy is a premier tax lawyer when it comes to both federal and state housing credits on affordable housing. So Judy has done a number of presentations, and I'm sure there will be time for questions as we go along, or certainly at the end. And thank you, NIFA, for allowing us to do this.
No, thank you. And I can attest to that, Patty. I've heard Judy speak at many a different conference over the years. So we're lucky to have her attend and explain a lot of things to us today. So, Judy, if you need anything shared on the screen, please just let Pam know what you would like to see, and we will let you go ahead and start off. And then if you have questions, please feel free to either enter them in the chat, or we will have time at the end for you to raise your hand and ask a question.
I don't know if it's possible, but I'm also okay taking questions as we go along, because the stuff is kind of dense. So
perfect. If you're good with that,
I know it can be tricky when you're like listening to a presentation and then you have a question and then like you get it answered 40 minutes later. It can be complicated. So.
Perfect. Thank you.
Okay.
Thank you for that. Sure. We will then watch for hands being raised, and then Pam or I will let you know, and we'll get you unmuted so you can ask a question.
Excellent. So if you could just throw the marked up statute up on the screen so I can kind of walk through what we did and why, and then we'll move on to structures that can be done with this.
Pam, you are on mute if you're talking out loud.
Yeah.
Yes, I'm sorry.
The perils of Zoom. Oh, that's so relaxing. I love the trees.
Oh,
okay.
Thanks. Is it this one you wanted?
Yes.
Okay.
So actually, well, no, we had sent you a modified. I sent it just before it was modified.
Yep, right here.
That one. Yep. Mm-hmm. Perfect. Right there. Is perfect. Absolutely perfect. So, so the way this started was a discussion with NIFA about finding ways to potentially amp up the value of the credit and also make it more readily available to different investors. It may surprise folks to know that not every investor wants to be a partner in a tax credit partnership to get state credit. Sometimes they would just prefer to purchase it, kind of like you buy a car. And prior to this, the Nebraska low-income housing tax credit was solely allocable. So I'm going to be using the concept of allocable or allocation and certificated or transferable. Okay. And we started by talking about different states, and because, there's 50 states plus territories, and many of them have credits, and none of them are exactly like each other. So we looked at what has worked well in different states. We mainly focused on the Massachusetts model, but we modified it. So the first thing you're going to notice is we deleted the concept of a qualified taxpayer, because prior, if we had left that in order for someone to purchase the tax credit, they also would have had to own an interest directly or indirectly in a low-income housing tax credit project. And that kind of defeats the intent of opening up the market and being able to sell the credits. We have added a definition for pass-through entity that will become important as we move forward. And it is, the three things that exist under federal law, right? A partnership, a limited liability company, or an S corporation. If we go down also on that page, one more thing, you'll notice that in the definition of taxpayer, we added a nonprofit corporation that is exempt from federal tax under 501c3 or 501c4. And this will become important when we begin talking about potential structures for how to move these credits around. So moving down further, you'll see that we got rid of the idea that a qualified taxpayer is allowed a non-refundable credit and changed it to an owner is allowed, right? And an owner is obviously the owner of the project. And paragraph 3 that's on your screen is the real meat and potatoes of what we did. So it tells you that if an owner is a pass-through entity, then the credit will be allocated among some or all of the partners or members or shareholders of the owner, right? And then any pass-through entity that gets an allocation, either from the owner of the project or from another pass-through entity, because as you have likely seen, because we like to do things in a complicated way, there are frequently tiered pass-through entities involved in these deals. So you might have a partnership owning it, and then a general partner that is a partnership, and then there are parties behind the general partner, right? And this is saying that a pass-through entity that has gotten an allocation either directly from the owner or from another pass-through has a couple choices. It can choose to further allocate the credit amongst its partners, members, or shareholders, or it can transfer, sell, or assign all or a portion of the credit to a taxpayer, right? And it again reminds us that a pass-through entity can allocate the credit in any way they want. So they can send it 100% to one of their members if they're choosing to allocate. And a partner, member, or shareholder that is allocated a credit, if it's an allocation, they would have had to have been admitted to the entity they're getting the allocation from by February 15th of the year in which the return claiming the credit is filed. So that's also nice because you don't actually have to be admitted in the year in which the credit flowed, right? So we're in 2026. Let's say you have not yet been admitted as a member of the general partner. The general partner's been admitted, but they're out there in the marketplace looking for folks who might be interested in this credit. They can admit you up until February 15th of 2027, and you can still be allocated credit for 2026. So that's a nice little float period that a lot of folks who work with state credits find helpful. And then it goes on to remind us that a partner, member, or shareholder of a pass-through can transfer, sell, or assign any of their ownership interest, including their interest in the credits that were allocated to them. And a taxpayer can also transfer, sell, or assign all or any part of tax credits that have been transferred to them. So we've tried to create maximum flexibility. There are going to be forms that have to be filed with the Department of Revenue with any allocation, transfer, or sale, because obviously the Department of Revenue is going to have to track through where the credit is going. And if we scan down a little more, one of the other changes we made, the other major change, was that this applied to taxable years beginning or deemed to begin on or after January 1, 2024. So even though the statute itself wasn't passed until well after that, we included a retroactive effective date for these sections so that there was the ability to engage in transfers of credits from 2024, which, is, I again believe, beneficial to those who work with syndicated credits. So why did we want to make transfers happen? When you allocate credits, right, there is no federal deduction for state taxes paid for the party who is getting the benefit of those credits. So if I am in a partnership with Patty and Sarah, and I allocate all the credits to Sarah, and she, takes them on her Nebraska tax return, the federal government does not give her a deduction for her state taxes paid. So those credits are going to be automatically capped in how much they're worth, right? Because you're still going to be paying federal taxes. If we sell them to Sarah, then Sarah will get a federal deduction for state taxes paid equal to the amount of credits that Sarah purchased. Sarah, unfortunately, is also going to have a slight tax bill because their feds will collect tax on the difference between what Sarah paid for the credit and $1. So let's say we sell them to Sarah for 80 cents. Sarah is going to have taxable income of 10 cents for each dollar of, or 20 cents, sorry, for each dollar of credit, but she'll get a federal deduction for state taxes paid of $1. So in the end, Sarah financially has a much better return if she's buying the credits than if she's being allocated the credits. So I just want to pause and see if anyone has questions on the genesis behind how we got here and the concept of, a sold credit versus a allocated credit. No, we're all good? Okay. So if you can throw up the chart that shows, and so I will tell you, I made a chart to show us, you'll have to make it a little smaller to all fit on the screen, to show us, how we could do these things. There are multiple ways because the statute was drafted in a very, very flexible manner, which I view as a positive. There are a number of ways that these credits could flow. So you'll see there is ABC Owner Limited Partnership, right? So they are the ones who own the property, okay? And they're the ones who are initially going to get an allocation of state credits. Now, under the revised statute, all ABC Owner Limited Partnership can do is allocate the credits, because although pass-throughs are allowed to sell them, they have to be at least one level up from the owner. So the owner can only allocate, it cannot sell. So in this chart, you're going to see that if you look at ABC SLP LLC, which apparently has LLC in there twice. I apologize. We have 100% of the state credits and 0.01 of the federal credits moving to them. So then they have the state credits, so they can do a variety of things with them. One option is they can sell them directly to the credit buyer, right? And you'll see a line that has option 2 above it. It says sell directly to buyer. That likely makes sense if there's a non-for-profit behind the state credit investor, right? So if there's a not-for-profit behind the state credit investor gets allocated 100% of the state LIHTCs. They sell them to the credit buyer. They get dollars back from the credit buyer, and they make a capital contribution. Things you have to be aware of there is your federal investor may be a little concerned that it's too close to the owner partnership, and that if it was to be collapsed, it would, collapse down to them as the seller. Now, we can point to the statute and say, look, the statute says the owner can't sell them, so it had no choice but to allocate them. If ABC SLP LLC is backed entirely by a nonprofit, any income that they get, assuming they have not elected to be taxed as a corporation, is going to not be subject to tax, right? So that's one option. Another option is if ABC SLP LLC has a for-profit entity behind it, they may instead prefer to donate the credits to a 501c3. And that's why we have added the concept of a 501c3 being a taxpayer, right? So that the taxpayer can get a transfer of the credit. So they would donate them. They would not take a charitable deduction, however, for the donation. And then the 501c3 entity would sell them to the credit buyer and typically would loan the vast majority of the proceeds back in directly to the ownership partnership. And that loan, we would prefer it to have some interest on it, but because it's coming from a 501c3, it's not actually required to. And, we would typically say it should have no longer than a 40-year term. The thing to be aware of here, of course, is the 501c3 entity who is getting a donation and then selling them also really wants to maintain its nonprofit status. So you can get into some discussions about what does that mean for them. Typically, it would be a 501c3 who has as one of its purposes supporting the development of affordable housing. So it's not, like you haven't found like a 501c3 that is a museum that's going to step into this role. That's likely outside its charitable purpose. And that is probably not going to end well for that 501c3. The other reality here is the loan does have to be respected as a true loan. And when we do use this structure, those 501c3s expect at some point to get paid back. So it's not a forgivable loan. The other ways this could work is you could skip altogether having a state limited partner LLC. If, for example, a state limited partner LLC is most frequently a syndicator. And instead, the state credits could also go directly to the general partner, right? They could be allocated to the general partner, and the general partner could donate them to a 501c3 who sells them and loans the property back in, or the general partner could sell them directly to a credit buyer. Again, the challenge with all of this is whoever is selling them has income. And so that's why we spend a lot of time looking at how that gets managed. The federal investor, even though we have this happening at least one level up from the ownership entity, tends to be concerned about what would happen if the IRS collapsed it all down and said the federal and the partnership sold it. And in those instances, the way we usually get the federal investor comfortable is we will have a special allocation of any deemed income from a sale of the state credits to a for-profit partner of the ownership entity. So sometimes that will actually be the state limited partner LLC, depending on what their structure is. Sometimes that will be the general partner, depending on their structure. But if all the other partners, besides the limited partner, are nonprofits or tax exempt controlled entities, then it gets a little more complicated, and there may need to be additional discussions around guarantees and whatnot. There is also usually an indemnity running from whoever the guarantor is on the deal to the federal limited partner that indemnifies them in the very off chance that any of these dollars from the sale of the state credit hit the limited partner. The other thing I should note is just because you can transfer or sell the credits doesn't mean you have to. And there remain some state credit investors who only want allocated credits because the federal deduction for state taxes paid does not benefit them. We've seen this in other states, including the state I live in, Massachusetts, but also in California and other places where the credits have been modified so they can be either allocated or sold. There will be times when you are soliciting for a state credit investor or buyer and you hear, I have tax liability in Nebraska. I can use the credits, but I don't want to purchase them. I want them allocated. And the nice thing about the way the statute's drafted is that is still completely permissible. So you have, all the options in terms of how it gets managed. Any questions? I know that's a lot.
Yes. Does anybody have any specific questions?
Really? I was that clear?
So Judy, if in your example, the ABC SLP LLC is a 168H entity, right? Then it's just a C corp, and it's going to recognize gain and get the federal deduction for state income taxes paid. Is that?
Well, no. So because they're not the buyer, right? They're so they can sell it if they have a 168H6 election in place. My strong recommendation would be that they donate to a 501c3 who then sells, and then the 501c3 loans the money back in. Because if they have a 168H, so let's say ABC SLP LLC has made a corporate election and a 168H6, and a corporate election is necessary to be eligible to make a 168H6 election.
Right.
And the effect of, and you probably know this, but I'm sharing this for anyone else because now we're talking in code. The effect of an election under section 168H6 of the code is that the nonprofit that is behind the corporation that has made the election will have to pay tax on anything it receives as unrelated business taxable income. So you're creating double tax on every dollar that ABC SLP LLC receives. So if they have a 168H6 election in place at the SLP level, my strong recommendation would be find an appropriate nonprofit that, has as one of its purposes assisting or lending or supporting affordable housing, and donate the credits to them. And then that nonprofit will sell the credits. The income should hit that nonprofit, right? Not the entity that has the 168H6. And then that nonprofit will loan the proceeds back to the owner. Typically, the nonprofit will strip off like a 0.5%, loan fee. And then they will, make a loan and get a note and usually a mortgage, although obviously on certain kinds of deals like HUD, that isn't so much a thing. But they will typically get a note and a mortgage, and it's usually, the loan is typically 30 or 40 years. And ideally at some percent interest, but we can live with 0% if needed, as long as the residual analysis on the deal shows it can be repaid. Now, in that situation, your federal investor is still going to say, I want to be able to specially allocate any deemed income to, and to someone that isn't me. So they may turn to the SLP that has the 168H6 election and ask to specially allocate it to them, or they may ask to specially allocate it to the GP, assuming the GP is not a pass-through backed entirely by a nonprofit. I will say, unless you have historic credits, energy credits, or, something else going on in your deal, we are actually not seeing a lot of 168H6 elections these days. Again, they can be necessary to protect bonus depreciation, but a special allocation of the state credits should not impact your eligibility for bonus depreciation. So, I'm not, it's an election we used to require all the time in the olden days, when we, had 27.5-year depreciation and we weren't worried about electing real property, trade, or business that already throws you into alternative depreciation. But I will say it's fairly rare these days to have it, again, unless you have historic or energy happening.
Makes sense.
Okay. And if anyone didn't understand all the stuff that Jesse and that we were just talking about, please raise your hand, because there was a lot of what I'll call sort of higher level complicated tax analysis in that one.
Anyone else have any questions? So we've learned that this is not an easy process. That there's a lot of flexibility with the change, which is fantastic. But then that also means that there's just not one way to do things. So, as far as feedback for maybe, do you have any suggestions for maybe a nonprofit that's wanting to explore how they could become more involved on the credit side. Do you have any guidance or any just suggestions, basic information?
I mean, so so my first suggestion is look at your formation documents, and if necessary, consider modifying your charitable purpose to include supporting, or assisting in the development of affordable rental housing. Depending on the nonprofits that already exist, I believe there are a couple that would fit the bill readily for serving in the role of the nonprofit that gets the donation and loans the money back. But certainly other nonprofits that maybe have been nibbling around the edge of housing, like if they're providing a lot of supportive services, for example, which is a very typical type of nonprofit we encounter in this world, right? Where they provide supportive services, but they've never actually been involved in the development of affordable housing. That would be like a really positive candidate to potentially move into the space here. They need to, as a board, understand that they're really making a loan, right? Like there can't be any wink, wink, nod, nod, we're forgiving this in 40 years or 30 years or whatnot. These become real loans and they're real assets of the 501c3. And they do get a loan fee, and, they will need to behave like a lender. Now, what actually happens when one gets to year 40, well, hopefully we'll all be retired by then. But, I can tell you in Massachusetts, where we've had these options in place for, 25 plus years, and we have seen deals move to resyndication, right? That started with some of these structures. Those loans are typically either getting repaid as part of the resyndication, or they are getting assigned to the new buyer. That can get a little tricky because when you modify an existing loan, even though the original loan could be at 0%, when you assume a loan as part of an acquisition and modify it, you have to go to the applicable federal rate for your interest, or the value of the loan as to the partnership gets written down, and it negatively impacts their acquisition basis. So it doesn't negatively impact the 501c3, but it negatively impacts the deal. So these are the sorts of things when, I recommend that the 501c3 have capable counsel who has, either background in working in the credit arena with other nonprofits, because there's a lot of nonprofits in the credit arena, or, has access to co-counsel that works in that arena. Because the 501c3's interests are at times going to be at odds with other parties in the transaction. And there's a very famous case out of California from now a long time ago. It wasn't long ago when I started practicing, but now I'm old, where a nonprofit actually lost its status because it was basically only there for an exemption, and it was not a good situation. And so, we really want to see that the nonprofit that is participating in this way is actually doing so in accordance with its purpose. In the service provider example I mentioned, it'd be great if they were also providing supportive services to the deal, because that's another way to kind of support why they would take on this role. In Massachusetts, there's actually an entity called Blue Hub. It used to be Boston Community Loan Fund. Like, their entire purpose in life from the moment they were formed was to lend on affordable housing deals. And that was, before transferable credits and whatnot came to exist. So for them, this fits, like carrots and peas, right? Like, it's just perfect. And then when there are things like state historic credits, we also happen to have an entity called Mass Preservation that is a nonprofit entity that, has always worked for the preservation of historic buildings. So that's another one that has been able to, serve appropriately in this role. But I don't think just because you haven't in the past been involved in affordable housing that you can't transition your nonprofit. I just don't think the only thing your nonprofit can do is act as the conduit lender. I think it would be important to have other aspects of involvement. So,
Yeah. Do we have any other questions?
Sarah, yeah, this is Rob Woodland. I just had a question. In Judith, in your experience, like option one, where it goes to the 501c3 entity, who do you typically, who finds the end credit buyer? I mean, is that nonprofit usually the one that finds it? Or?
No. It is not typically the nonprofit that finds the end credit buyer. It's usually the general partner. On occasion, it might be the federal credit investor. One thing I should add is, if you have a federal investor who comes to you and says, well, I want to invest in the Fed credits, but then I want to buy the state credits. So I want to, I'm going to be the 99 point whatever Fed investor. And then I want you to send the credits in a big circle and I'm going to be the end buyer. I strongly recommend you say no, because there's not a non-tax reason for doing that, right? Like, there's no business reason if Bank A wants to be the federal investor and Bank A also wants to be the credit buyer. Bank A could get all the state credits exactly the same way it's getting all the federal credits, right? They could just be allocated to it. So if Bank A is saying, yeah, I want your state credits, but I want you to allocate them to this SLP or this GP, and then I want them donated to a nonprofit, and then I'll buy them, say no. Unless they agree not to make you guarantee the sale treatment. Because this is something we have run into, certainly in Massachusetts, and it's incredibly risky. So, if you're going to do it, I guess what I've always told folks who are considering doing this is make sure you have money, readily available to you that equals the amount of tax that you would have to pay if, or the amount of guarantee you would have to pay if the sale treatment is disregarded. Because your state investor is looking to get the federal deduction for state taxes paid. And if the IRS comes in and says, well, this is ridiculous, the only reason you ran this in a giant circle was to get that deduction, there's no valid business reason. And you have guaranteed to the federal investor, and the state investor, that they'll get sales treatment, you're going to have to pay the differential for their loss of that deduction. And everyone I've ever seen as a bank who tries to do this requires that the guarantor guarantee the sale treatment.
Thank you. My last question is,
you can have as many questions as you want.
That's right. Has this structure ever been challenged by the IRS, and has it passed that challenge?
It has not been challenged. So to my knowledge, there has not been any audit of this structure. There are a couple CCAs from want to say 2004, 2003, that were looking at the Massachusetts statute, which is similar but just a scooch less flexible. In Massachusetts, pass-through entities cannot transfer the credit. They can only allocate. So this is a little more flexible, right? That a pass-through entity that's one level up from the owner can sell or transfer. And those CCAs were focusing on what the impact was. They're the ones that concluded that you have income, that the buyer has income equal to the difference between what they paid for the credit and a buck. But there's, to my knowledge, been no audits or challenges to the sales structure.
Great, thank you.
Yeah, no, absolutely. Great questions.
Judy, a little bit on building on Rob's first question.
Yeah.
Is the typical credit buyer in option one the end user? So it'd be like
Yes.
the bank or it's not typically a state credit syndicator. Is that accurate?
It is not. Typically, your state credit syndicator is going to be where it says ABC SLP. That's typically going to be your syndicator. Now, again, because we put maximum flexibility into the statute, your credit buyer, if they purchase them and then, very bad things happen, like 2008, and they suddenly have no Nebraska income to shelter for the foreseeable future, they can turn around and sell them again. Which is a nice feature. The credits can also be carried forward if they exceed their Nebraska tax for any particular year. But, if they're really looking down the road and going like, we've got nothing and we have nothing for like the foreseeable future, they can turn around and find another buyer and transfer the credits.
Did that answer your question? Oh, great, Will.
Hey, Judy, first of all, thank you for your time today. It's been really helpful.
Oh, sure.
Just a quick question for you. From an economic perspective, does it potentially make more sense to do the certificated structure when you have a buyer that's willing to buy all 6 years of the credit up front, or is it somewhat agnostic?
It's, so your federal investor, if you're doing that sort of structure, is typically going to want to know that the buyer is going to buy all 6 years.
Yeah.
There are some syndicators who will sell in strips. And so we do see both things. One of the things that will happen here, though, right, is your buyer. I jokingly say they're buying a car, but they're really buying a car, right? Like if you go into a dealership, you might be willing to put down like $500 to reserve a car that they're going to deliver to you in a year, but you're not giving them the full amount up front. So in these deals, there will often be some kind of a bridge loan to cover the amount of money that should ultimately be coming when the credit buyer gets their certificate. So it is a little different than in an allocated credit deal. Typically, your state credit partner is putting their equity in pari passu with the federal investor, right? So if the Fed investor is putting in 10%, the state investor is also putting in 10% at whatever point in time. This is a little different. And so usually there will be a bridge. Sometimes the federal investor themselves will provide the bridge. Sometimes it comes from a more traditional bank. It just depends. But the bridge lender is going to be secured by the various documents that obligate the donation and ultimate purchase by the buyer.
No, that's very helpful because, like you mentioned, in a typical allocated deal, the money's coming in pari passu to the federal.
Right.
But in this structure, really the money is coming in once the state has issued the tax credit
Correct.
certificate. So the project then has the bridge loan interest that they got to take out once they
Right.
get that sale.
Mm-hmm.
Yeah.
Yep. And I mean, so, at the end of the day, I think you still, I think it still works out that the deal ultimately gets more with a sale versus an allocation, because that federal deduction for state taxes paid is worth a fair amount. And I think it's also helpful that the Nebraska credit is a 6-year credit. So
Yes.
it's, I mean, in states where the credits are 10 years, right? That's an automatic depression on value. But there is a meaningful bump typically in certificated versus allocable, even
Thanks.
with having to deal with a bridge loan and whatnot.
Thank you.
Yeah, no, absolutely. Any other questions?
Yeah, Darren Smith, Arch Icon Development. Do we know at this point if Department of Revenue will rely on NIFA's cost certification to issue the certificates, or if they'll need to do further review?
I think that's a NIFA question.
Yeah. So we will have a similar, they will rely on our cost certification, and we'll have a similar form to what we complete for the allocated credit. So it'll be very similar. They're working on forms on their end. So they will rely on us. They will not need to see, at least as far as we have had our conversations with them thus far, they will not need to see a cost cert separately. They'll rely on us.
Great, thank you.
And I will say DOR was aware of the statute and had some conversations before it was passed. So because there are some cautionary tales in other states where very good work was done to create a state LIHTC credit or expand a LIHTC credit, and then the DOR has put the kibosh on it, and that I am comfortable is not going to be the case here.
That is right, Judy. They have been, we have worked off and on with them since, since the beginning of this, right?
Yes.
so it's been a collaborative, and it was before. We do work with them quite a bit and are in contact with their office quite a bit to make sure that they get what they need to be able to manage the credit side of everything.
Yeah. Sarah, do you know, have the forms for that need to be filled out for DOR been put in place yet? Like the allocation and the transfer?
I need to check if they've been posted yet. They did
Okay.
send them over for our review to take a look at them, but that was quite some time ago. And I didn't get a notice, a for sure notice if they were posted. So
Okay.
we'll make sure of that. Definitely. And we'll try to follow up with that information when we send out a follow-up email regarding this session.
Excellent.
And
Any other questions?
Yeah, exactly.
It's like we have 9 minutes left. I can vamp. I could talk about other tax issues.
I don't know if some of our brains can take that, Judy.
Fair, very fair.
So I think part of the audience totally could roll with you on that. Then there's some of us that are like, oh, it's full.
Okay.
Hey, Judy, I have a question.
Yeah.
If you don't mind. This is Sonny Nunez. Can you kind of help me think through if I'm representing a development, right?
Mm-hmm.
And, I'm going to get an influx of cash for the state tax credits, right?
Yep.
It's my understanding, right, that there are kind of two ways for me to get that cash. One, I can get that cash from, use your example of the federal investor, where the money comes in as a kind of a capital contribution,
Yep.
or you refer to a state tax syndicator where the money comes in pari passu. And I think it's typical there that money comes to my project partnership tax-free, right, as a capital contribution.
Yes.
Okay. If and then you talked just now about like when I think Will asked the question about like the economics of the certifying the credits, so
Right.
it when I'm comparing the two and helping someone figure out, again, kind of modeling out like what it looks like on the certificated side, that means my project partnership has to pick up some income, right?
No, it won't if it's structured properly. So your project partnership federal investor, because
Yeah.
I say this with all the love in the world because I represent a lot of investors. Investors tend to, I mean, my job when I represent investors is to think of all of the bad things that could theoretically happen, even if they've never happened, and even if they're incredibly unlikely to happen, and try and protect against them. Right. So the way this would be structured, any transfer of the credits is not happening at the ownership level. Right. And in fact, under the statute, it can't. Under the statute, all the owner can do is allocate the credits.
Okay.
But once they've allocated them, then the party they've allocated them to, whether it's a partnership or a taxpayer, meaning like, an individual, corporation, nonprofit, yada, yada, they can transfer them. Now, the reason federal investors get squirrely is they worry that at some point, someone at the IRS could come in and say, nope, I don't care what the Nebraska statute says. Somehow I'm interpreting this as the ownership entity sold them.
Yeah.
And that's why we have special allocations and indemnities and such. The reason you would consider going with a sales structure is because the amount you get for each credit is meaningfully more, right? So because you are getting the value of that federal deduction.
When you say like you are getting the value,
the ownership entity is the state credit dollars that will flow into your project will be higher.
And those are flowing through like the person that got it. Yeah, that got it. If it's got to be allocated from the beginning.
So let's say it's allocated to your state limited partner.
Yep.
And let's say your state limited partner is owned 99.99 by a nonprofit and 0.01 by a guy named Joe.
Got it.
So your state limited partner in that instance can just sell directly to the credit buyer. And when they get, $5 million or however much they're getting for whatever the allocation was, 99.9% of that's going to go to their nonprofit, and a tiny bit will go to the guy named Joe, and then they'll put it in as equity.
Got it.
And so then, I mean, that is, I think, slightly, I will say, I think that is slightly preferable from a developer standpoint than it goes to a state limited partner or a GP who donates it to a nonprofit, and then the nonprofit sells it and loans the proceeds back in, because then you have a loan on your deal.
And then at some point, if that loan,
you have to deal with it.
And kind of dealt with the wink, but at some point, if it gets forgiven, you pick up CO. There's just something hanging out there.
Yeah, I mean, I have not ever seen them be forgiven. I can tell you that. But I have seen them need to be refinanced. I have seen sometimes they'll want some cash flow.
Yeah.
So it just depends. Usually they are truly just pay at maturity. So, and there is the whole, well, yeah, it'll be a challenge in 40 years, but for now we get this really good deal.
That's right. It's just kind of kicked down until like someone younger than us is dealing.
Exactly. Yes. If I am still working at 95, then there's a problem. So,
no, that was very helpful. Thank you.
Yeah, no, absolutely. So Sarah, would you be able to send out my contact information to everyone who participated? Just because I want to offer, if anyone has any follow-up questions, it's completely fine to email me and I will answer you.
We definitely will. We will send out a follow up to this session. We have recorded it,
Great.
and so we'll send out a follow up email and touch base with you and Patty to make sure all the information you'd like to see included is included. So
Perfect.
we'll get your contact
Yeah,
info.
I just want people to be able to ask me follow-ups. I always feel badly when folks don't know how to do that. So,
well, we appreciate it. Thank you very much, everyone, for joining today. We appreciate your time, Judy, Patty. Again, thank you.
It was fun.
Good. That's good. My brain is still chewing on
turning.
it all. I took a ton of notes. Yes.
Go eat chocolate. It will help.
Yeah. As soon as I think I got this, then
I understand.
But we appreciate it, and we will again follow up on an email. Thank you, everyone.
Perfect. Thank you, everyone.
Thanks all. Thanks,
Bye.
Judy.
Yep.
Bye-bye.